I'm Imran, your instructor. In this lesson, we are going to discuss IFRS 10, Consolidated Financial Statements. So, IFRS 10 lays down the rules for when and how a parent company should prepare consolidated financial statements. That basically means bringing together the financial results of the parent and all its subsidiaries into one single report. Now, here's the big idea behind IFRS 10. Entities must consolidate other entities that they control. And by control, IFRS 10 means a very specific thing. It says the investor must have power over the investee, be exposed or have rights to variable returns from that investee, and also have the ability to use its power to affect those returns. So yeah, just owning shares isn't always enough. You need to show that you can actually influence what happens in that company. Now, a bit of history. IFRS 10 was issued back in May 2011. And it became effective for annual periods beginning on or after 1st of January 2013. So if your company's year starts in January, then you'd have to start applying this from 1st of Jan to 2013 onwards. All right, that's our setup for IFRS 10. All right, now we go into the main objective of IFRS 10. So yeah, IFRS 10 is all about setting the rules for when and how to prepare consolidated financial statements. The standard kicks off by saying its goal is to give us clear principles for both the presentation and preparation of consolidated financial statements when one entity controls one or more other entities. Basically, if a company has control over other companies, then this standard tells us how to combine all their financials into one big report. Now, what does the standard actually require? Let's break it down. First, it requires that any parent entity, which means a company that controls one or more other companies, must present consolidated financial statements. So, second, IFRS 10 defines what we mean by control. It says, control is the basis for deciding whether or not to consolidate. So, if you don't have control, you don't consolidate. But if you do, even partial, you're in. Third, the standard explains how to figure out if an investor controls an investee. I mean, sometimes it's obvious, like owning 100% of another company, but sometimes it's tricky, like when you own less than 50%. IFRS 10 tells us how to apply the control test in all these cases. Next, it also sets out the accounting requirements. So once you've figured out who controls who, the standard tells you how to actually prepare the consolidated financial statements, like how to combine the assets and liabilities, eliminate intergroup balances, that sort of thing. And finally, there's one big exception. If the parent company is what we call an investment entity, then it doesn't have to consolidate certain subsidiaries. Instead, it might just measure them at fair value through profit or loss. But that's a special case. So yeah, the heart of IFRS 10 is simple. If you've got control, you consolidate, and the standard tells you exactly how to do it. All right, now we discuss some key definitions in IFRS 10. First up, consolidated financial statements. So what are they? Well, these are the financial statements of a group where the parent and all its subsidiaries are presented as one big single economic entity. I mean, you take all the assets, liabilities, equity, income, expenses, and cash flows and put them together like the group is just one company. All right, next we have control of an investee. So IFRS 10 says an investor controls an investee when three things happen. Number one, the investor is exposed or has rights to variable returns from its involvement. Number two, the investor has power over the investee. And number three, the investor can use that power to affect those returns. So yeah, if you've got the ability to influence outcomes and also benefit from them, you're in control. Next up, investment entity. This one's a bit different. It's a special type of entity that doesn't always consolidate its subsidiaries. So an investment entity has three key features. One, it gets funds from investors, so it can provide investment management services. Two, its main purpose is to invest those funds to earn capital gains or income, or both. And 3, it measures and evaluates almost all of its investments using fair value. So yeah, these are like fund managers or private equity firms. They usually don't consolidate. They just report the fair value of investments instead. Now, parent. That one's simple. A parent is any entity that controls one or more other entities. All right, let's talk about power. Power means having existing rights that give you the current ability to direct the relevant activities of another entity. Not just potential rights, we're talking about actual real deal decision-making power. And then we've got protective rights. These are different. They're just there to protect someone's interest, but they don't give control. For example, a lender might have protective rights to stop a company from selling its main assets, but that doesn't mean the lender has power. And finally, relevant activities. These are the activities of the investee that significantly affect its returns, like making decisions about sales, operations, or strategy. Whoever can direct those activities probably has control. All right, these terms pop up again and again, so make sure you're comfy with them. All right, now let's bring IFRS 10 to life with a real-world example. So imagine this. We've got a company called Alphatech Limited. Alphatech is a software development company based in London. Now, Alphatech recently bought 60% of the shares in another smaller company called Beta Apps Limited. So yeah, Alphatech now owns the majority of the shares. But remember, IFRS 10 doesn't just look at shareholding, it looks at control. So the question is, does Alphatech control Beta Apps under IFRS 10? Let's run through the test. First, does Alphatech have power over Beta Apps? Well, yeah. With 60% of the voting rights they can appoint the majority of board members and make key decisions. So that's a tick. Second, are they exposed to variable returns? Definitely, because as the main shareholder, Alphatech gets a big chunk of the profits or losses from Beta Apps. And third, do they have the ability to use their power to affect those returns? Well, yeah, again, they can steer Beta Apps' strategy, decide which products to develop, and so on. So putting it all together, Alphatech meets all 3 conditions of control under IFRS 10. That means Alphatech is now the parent and Beta Apps is its subsidiary. And what does that mean for the financial statements? It means Alphatech must now prepare consolidated financial statements. So they can't just show their own numbers. They have to combine their income, expenses, assets, liabilities with those of Beta Apps and present them as it's just one single economic entity. Any transactions between the two, like sales or loans, need to be eliminated in consolidation. And shareholders looking at the statements will get the full picture, not just of Alphatech on its own, but of the whole group. Now, let's tweak this a bit. What if Alphatech owned only 40% of Beta Apps, but still had the right to appoint most of the board members? Now we've got an interesting case. Even though they own less than half, they might still have control. Why? Because control isn't just about percentage, it's about power and the ability to affect returns. So if Alphatech could still direct the key activities of Beta Apps, then under IFRS 10, they'd still be required to consolidate. All right, I hope that makes the concept of control a little more real. All right, now we look into how consolidated financial statements are actually prepared. So IFRS 10 says, when a parent is preparing consolidated financials, it should use uniform accounting policies across the group. What does that mean? Basically, all companies in the group, they've got to follow the same accounting rules for similar transactions. You can't have one company using straight-line depreciation and the other using reducing balance for the same kind of assets. That would mess things up. So yeah, keep it uniform, keep it consistent. Now, here's an important twist. There are some cases where a parent company doesn't have to prepare consolidated financial statements. Yep, IFRS 10 gives a few exceptions. Let's break those down. The first one, if the company is a wholly owned subsidiary or even just partially owned and the other shareholders have been informed and they don't object to the parent skipping consolidation. Second, the company's shares or bonds are not traded in a public market. So it's not listed on the stock exchange or anything. Third, the company's not filing or planning to file with any securities regulator to get its financials published publicly. Basically, it's not trying to go public. And finally, its ultimate parent or even an intermediate parent is already producing publicly available IFRS compliant consolidated financials. So yeah, if all 4 of those boxes are ticked, then that parent doesn't need to prepare its own consolidated statements. Now, there's a special clause for investment entities. These types of companies, like private equity funds or investment trusts, are actually prohibited from consolidating certain subsidiaries. Why? Because their business model is different. They don't manage operations, they invest for capital growth or returns. Instead of consolidating, they just measure those investments at fair value through profit or loss. And finally, there's an exemption for post-employment benefit plans and long-term employee benefit plans. So if a company's running something like a pension scheme, it doesn't have to apply IFRS 10 either. All right, so that's the lowdown on when and how to prepare consolidated financial statements. All right, now let's take a real-world example to make sense of all this consolidation stuff. So imagine we have a company called Greenleaf Organics Limited. Greenleaf is a small organic farming company based in New Zealand. Now here's the deal. Greenleaf is 100% owned by another company, Nature Holdings PLC, which is based in Australia. So yeah, Greenleaf is a wholly owned subsidiary. Now the question is, does Greenleaf need to prepare its own consolidated financial statements? Well, let's test it using the 4 conditions in IFRS 10. Condition 1, is Greenleaf a wholly owned or partially owned sub, and have the other shareholders been informed and not objected? Yep, they're fully owned, so no problem there. Condition 2, are Greenleaf's shares or bonds traded in a public market? Nope, they're not listed on any stock exchange, not even on a regional one. Condition 3, is Greenleaf filing or planning to file its financial statements with any regulator to go public? Again, nope, no IPO plans. Condition 4, is the ultimate parent, Nature Holdings, already preparing consolidated financials that follow IFRS and are available publicly? Yes, Nature Holdings publishes full IFRS compliant consolidated financial statements every year. So guess what? Greenleaf ticks all 4 boxes. That means under IFRS 10, Greenleaf doesn't need to prepare its own consolidated financial statements. Now, let's flip the scenario. Let's say instead of Greenleaf, we're talking about another company, SolarMax Energy Limited. SolarMax is 70% owned by a parent company called Sun Invest Holdings. It's not publicly traded, but guess what? SolarMax is preparing to file documents with the Securities Commission because they plan to launch an IPO next year. Boom. That's a deal breaker. Even though it's mostly owned by Sun Invest, SolarMax is now required to prepare its own consolidated financial statements. Why? Because they're in the process of going public. So IFRS 10 says the exemption doesn't apply. So yeah, context matters. And one last thing, if either of these companies were investment entities like private equity firms, then instead of consolidating their subs, they'd simply report their investments at fair value through profit or loss. Totally different approach. All right. I hope those 2 examples help lock in the concept. All right, folks. Now we're going to talk about consolidation procedures and how it all works under IFRS 10. This is where we take the financials of the parent and basically blend them together with the financials of its subsidiaries. So let's break it down step by step. First off, we start by combining like items. I mean, if the parent has cash and the subsidiary also has cash, then we just add them together. Same goes for receivables, inventory, liabilities, equity, and even income and expenses. So yeah, you're looking at one big merged statement as if the whole group is just one single business. Got my point? Cool. Now, here comes the part that trips people up. The parent's investment in the subsidiary? That's got to be eliminated. Like if parent co owns shares in subco, we don't just keep that investment sitting there in the group balance sheet. Why? Because that ownership is now internal. So yeah, you offset the investment against the parent's portion of the subsidiary's equity. And any difference, that's where goodwill comes in. You remember goodwill, right? That fuzzy number we calculate during business combinations like excess payment for expected synergies? Exactly. Okay, now let's talk about intra-group transactions. Any sales, loans, dividends, or payments made between the companies in the group, you got to eliminate those too. For example, if the parent sells inventory to the sub for 100 cow, and that inventory is still sitting on the shelf at year end, you can't recognize the profit from that sale in group income. Apparently, it's not a real profit until someone outside the group buys it. So yeah, eliminate any unrealized profits or losses on those intercompany deals. Got my point? Group equals one single economic unit. So no self-dealing allowed. Now, timing matters too. You only include a subsidiary's income and expenses in the consolidated financials from the date you gain control until the date you lose control. So let's say you bought Subco in March. You only include their numbers from March onwards, not from January, not the whole year, just from when you became boss. And you base that income and expense on the values of the assets and liabilities as they appeared on acquisition day. Okay, here's something important about reporting dates. The parent and sub should ideally have the same reporting date. Like, if the parent reports as of 31st of December, then the sub should too. But what if that's not possible? I mean, sometimes the sub is in another country, right? Well, IFRS 10 says that's fine if it's impracticable to align the dates. But the difference between reporting dates should not be more than 3 months. And if there were big transactions between the two dates, you got to adjust for those. So yeah, don't just copy paste the old sub's financials, update for any major stuff that happened in the meantime. All right, that's the essence of consolidation procedures. You blend similar items, you cancel out anything internal, and you only report what's real from the group's point of view. Simple? All right, now let's wrap up IFRS 10 with the last key concept, non-controlling interests. So under IFRS 10, a parent company has to present non-controlling interests, or NCIs, separately in the consolidated statement of financial position, like within equity, yeah, but apart from the parent's own equity. So think of it this way. The parent's equity sits over here, and the NCIs sit right next to it, but not mixed in. Now, here's the thing about profit or loss and other comprehensive income, or OCI. IFRS 10 says that the reporting entity, that's the group, right, needs to attribute both profit or loss and OCI to two parties, the owners of the parent and the non-controlling interests. So yeah, even if the NCI owns, like, I don't know, 25%, they still get their 25% of the group's profit and OCI. It's all based on current ownership. So if the parent owns 75% and NCI owns 25%, then profit and other income are split 75-25. Got my point? Cool. But here's the interesting part. Even if the NCI's share causes them to go into a deficit, yeah, like a negative balance, we still show it. Apparently, IFRS 10 wants total comprehensive income to be fully allocated, no matter what. So yeah, even if the NCI's piece is a loss, we still report it under their name. That's how we treat non-controlling interests in consolidated financials. And with that, boom, we've covered the full scope of IFRS 10, consolidated financial statements. Not too bad, right? I mean, yeah, a little technical, but once you break it down with real-world logic, it all clicks. All right. I'd strongly suggest, for a deeper understanding, read the actual IFRSs and IASs, like go straight to the source.